Yo, hello traders, it's your one and only Forex Q coach, Tim Legend, and I'm super excited having you all here today on this one. Alright, if this is your first time on my channel, could you do me a little favor? Hit the subscribe button, turn the notification bell on so that you don't miss out a single thing. Because right here in this channel, all I do is to post content that help you win in the financial market. So hit the subscribe button and turn the notification bell. Now let's begin. So today I said we're going to be talking about chart pattern. Chart pattern is also a very important thing that we need to understand because it also gives us an edge to know where markets might likely go next. Okay. Now, when we talk about chart pattern, what is chart pattern? Chart pattern simply means the way markets moved and what it formed when it was moving. Okay. Now, history has got it to be that on the forex, in the forex market, whatever happened in the past, there's tendency that it can likely happen again. Okay, whatever happened in the past, there's tendency that it might likely happen what again in the future. Okay, now we're going to take a good look at things that happened in the past and see how they occurred again in the future. Now we're talking about chart pattern. Before I show you any chart pattern here, let me draw out some chart patterns for you so that you get to see and understand what it means. Now, for the chart patterns, I'm going to just give you the most important ones. There are quite a lot. For the bullish patterns, we have what we call a double bottom. We also have what we call a falling wedge. This is how it looks. Under the bullish patterns, we also have what we call inverse head and shoulder. And this is how it looks. Okay. These are the most important three bullish chart patterns you want to learn, and you learn also how to use it in the markets. Now, let me explain before I go for the bearish. Now, this is called a bullish chart pattern and is known as double bottom in the sense that number one, you can see it has what? Two bottom. This is one bottom and this is a second bottom. That's why it's called a double bottom. Also, there's also a triple bottom. That's why you see it create triple bottoms like this. Okay, but you hardly see it though, but you see more of the bullish the double bottom. So number one, it has two bottoms and is a bullish pattern in the sense that during this era, the bears pushed markets down, the bulls pushed up for a little while, the bears rejected again, and when they rejected, because it has created a bottom before and created a second bottom, the next thing that happened was the bulls pushed up, and there is always tendency that they push up even higher during this era. All right, in this part, within this pattern, here is known as the neckline. This is the neckline. The neckline in the sense that when the bears rejected markets and the bulls pushed up, price stopped here and the bears rejected again. So there is every tendency that when the bulls start pushing up again, they can likely get rejected in this same place again and go back down. You're going to understand this logic when we start talking about support and resistance in the very soon. Support and resistance, that's another thing you guys need to learn. Okay, so there's every tendency that when the bulls start pushing up, they can likely get rejected by the bears again and push down. So for them to break out of this zone means this was the neckline. And that's why, because it's a bullish chart pattern, they pushed really high. We're going to understand it when we get into the chart, or let's go into the chart so that we talk about it for now. We want to spot out a double bottom on the charts. So let me find one and give you a typical example of how these patterns look like. So there are things that you have to learn how to do, which is what? You have to learn how to train your eyes to be able to see all these things easily on your charts. This is what we call a double bottom. Now you can see after the bottom formed, what happened? The bulls pushed massively. Now, during this era, which is the neckline, you can see what happened during the neckline. When the bulls pushed, the bears showed up here. You see the bears, they showed up here. Why? Because this is a neckline. There's every tendency that if the bulls were not strong enough, the bears could have rejected them again. And when they pushed and broke through the neckline, the bears tried to push back down. And when they still got to that same neckline, what happened? The bulls took strength again and pushed up. You understand the logic of what is happening during this era when we start talking about support and resistance. All right, let's look for another double bottom. This is a typical example of another double bottom. This is one bottom, this is second bottom, and this was a bullish move. Okay, so you must understand that when you're looking for your bottom, the double bottoms, okay, it must not be as perfect as W, which I've just drawn here. It must not be perfect. There are different double bottoms. Maybe I will drop that video on my is on my YouTube channel, where you see different double bottoms and double tops. You can see a double bottom like this, and it goes bullish. You can see a double bottom like this, and it goes bullish. All right, so it must not always be what? Perfect. So let's find one more double bottom and we head to the next chart. Now here we found another double bottom, and you see how massively it pushed to the upside. So this is for double bottom. So whenever you see this pattern form on your chart, it's giving you a signal that, hey, if you want to look for a buying opportunity, look for a buying opportunity, because you might likely follow the bullish move and make some money. Okay, now I call this what? A falling wedge. Falling, F-A-L-L, all right, F-A-L-L-I-N-G, then wedge, W-E-D-G, all right, it's probably W-E-D-G-E. Falling wedge. Now, why is this a bullish market? But it's falling, so why should you call it a bullish market? That is because this is how it usually forms. You will see a bearish momentum. The bears will be pushing down for a while, pushing down, and suddenly you will just see from here the bulls will spike it upward. All right, it happens quite a lot of times in the markets. It's called a falling wedge because it's falling, and the next thing is you see a strike to the upside. Let's look for some opportunities like that on our charts, where we would have to see the bears push down and push down and push down, and suddenly we'll see the bulls strike up. This is an example of a falling wedge. Price pushing down, and suddenly what happened? The bulls striked up. All right, the bulls did what? They striked up. Let's look for another opportunity. This was another falling wedge between here to where they fell all the way down. All right, and what happened? The bulls striked up. So when you see price falling like this, you can likely start drawing out your falling wedge. All right, but already you must have seen price create this first bottom during that era, and the second bottom was about to come. So you already have two different confluences, double bottom and falling wedge, proving that if care is not taken, this market might likely push to the upside. Okay, this is a typical example of another falling wedge. All right, so whenever you see it in the market, it's telling you that, look, don't think that it's going to sell for a long time. The bulls might likely push up anytime soon. So let's look at the next pattern, which is what? An inverse head and shoulder. Inverse head and shoulder. Is it a bullish chart pattern? Because you can see clearly that the bears pushed down, the bulls pushed up for a while. The bears rejected massively this time. The bulls rejected. The bears said never, we're still going down. And suddenly after that, after the first shoulder had formed, this was the head, this was the second shoulder, the bulls pushed. This was the neckline. Here is the neckline. The bulls pushed and broke the neckline and kept going upward. That's why it's called inverse head and shoulder, because it's upside down. When we talk about the bearish head and shoulder, that one, there's no inverse on it. It's just head and shoulder. But because this is for the bullish, it's called inverse. All right. So this is the shoulder, the two shoulders, and this is the head. So it's for the bulls because the bears rejected. the bulls rejected, the bears pushed down, the bulls pushed down, the bears pushed down, and the bulls massively pushed up. Now let's look for some examples on the charts. Let's look for some examples of an inverse head and shoulder. This is a typical example. From here, they pushed up, they pushed down, they pushed down, they pushed down, and boom. All right, a typical example. Like I told you guys, you must learn, if you want to be a very good trader, you must learn how to train your eyes to easily see these things, because it gives you a good opportunity for you to be able to see it even before it completes its formation. You would be able to take advantage on time. Imagine if you took imagine if you bought here and you bought and price kept on going as high as you know how much you can make in a day. That's quite a lot of money. Why? Because you are able to train your eyes to see the pattern that was forming even before it finished forming. All right. So that's for an inverse head and shoulder. I can see another one for here for now. Let's talk about the bearish markets now. All right. So I've given you 3 different chart patterns you can be looking out for when you want to look for a buying opportunity. What about a selling opportunity? You want to look out for what we call double top. Remember, we had this double bottom. Now this is double top. All right. And the next is what? Remember, we had this falling wedge. Next is going to be a rising wedge. Here's how it goes. It's, all right. A rising wedge. And the last, we have an inverse head and shoulder here. Why now we're going to have a head and shoulder. Okay. Why is this bearish? Because you can see clearly the bulls pushed up, the bears rejected, the bulls pushed up, and the bears at this time rejected massively. For the rising wedge, the price was going like this. It kept on going like this. Before you know it, the bears broke it back deep down. Okay. For the head and shoulder, you can see how price was going. The bulls pushed up, the bears pushed down, the bulls pushed up, the bears pushed down, the bulls pushed up, and then the bears pushed deep down. Here is the neckline. Here is the neckline for this one. So let's go to the chart and look out for some of this pattern and see how they formed and how they moved after they formed during their era. So now we're looking out for words, 3 different patterns. We're looking for head and shoulder. We're looking for double top. We're also looking for words, a falling wedge. So let us figure out some around here. Now we can, I haven't seen any yet. I'm looking for a clear one. Okay, here we have a head and shoulder. And it sold well. Okay, let's look out for another one. Let's look out for another one. Here we had a double top and it sold down. Okay, let's look out for a rising wedge. All right, and see how after rising for a while, it broke deep down. Okay, so you need to go to your charts and train your eyes to be able to see these things whenever they form. Okay,
please hit the subscribe button and turn on the notification bell.